I'm now showing you a graph that I call four price levels for the firm in pure competition. I've shown our marginal cost curve, our average total cost curve, and usually in terms of the graphs for our business structures, I don't show the average variable cost curve, but in this case, I show the average variable cost curve because it's important to also understand at different price levels how the average variable cost curve will come into play. Now, we recognize that there are different price levels over here on the left, P1, P2, P3, and P4. I've drawn a dashed line across where they intersect at various points in terms of the marginal cost curve. And they will also intersect at points where marginal cost is equal to average total cost and also where it's equal to average variable cost. And it may not be clear, but that marginal cost curve does intersect the average total cost and average variable cost curves at the minimum. So first, P1. P1 is basically a short run situation for the firm in pure competition, because here's what's happening at that level. At that price level, we take a look at the price, and the profit maximizing price is going to be where marginal revenue equals marginal cost, and so that in this case, the horizontal line would basically be the price level for the firm. And part of the reason why I'm showing it in terms of pure competition is because, remember, the demand curve in pure competition is a flat line. So in this particular case, this would be the price. And look what happens in terms of the average total cost. What we see happening here in terms of average total cost, we see that guess what? Price is above average total cost, so we know that they're earning economic profit. We know that this is a short-term situation because for pure competition, if a firm is earning economic profit, other firms are going to enter the industry, and they're going to lose some of their customers as a result of other firms entering the industry. But more importantly, they're going to start losing their profit, because we showed in terms of the dynamics in terms of the firm in pure competition, where they are earning economic profit, prices will come down because there's more supply of firms entering the industry, and price will come down, and they'll begin to lose market share. As a result of losing market share, now what's going to happen is that we're going to now have a price level at P2. And we take a look at here, and here's what we're looking for in terms of those equations, in terms of allocative and productive efficiency, where price equals marginal cost and price equals the minimum of average total cost. And that's the situation that we're looking for in terms of basically an equilibrium. And that's what we see here at P2. That's kind of the long run situation for firms in the industry of pure competition. Now we take a look here at P3, and we say in terms of P3 is below. P3 would be at this point here, and we say, oh, gee, at this point here, they are below. They are below of average total cost, and so now we say, gee, now they are operating at a loss. Now, we also know that in business, there are many firms that operate at a loss as long as they are able to. And why do they operate at a loss? Because they think that they will be able to either lower their costs, or that they'll be able to differentiate their product in some way so that they can raise their price so that they'll get more into that profit picture. They have hope. Now, they will continue to have hope until when? Until things drop down to P4. P4 is at that price level where price is at the minimum of the average variable cost curve. Now, as long as price is above average variable cost, they are covering some of their fixed costs. Fixed costs are basically the difference between average total cost and average variable cost. that's an important idea to remember, that in terms of fixed cost, average fixed cost, are that difference between average total cost and average variable cost. And as long as price is covering some portion of their average fixed costs, which typically we might identify as rent, as long as they can pay the rent, they may be able to keep the doors open because they're able to pay their variable costs. But as soon as they are no longer able to cover their fixed costs at all, which means that all they're able to cover is their average variable cost, there's an important idea here, and that idea is, see how yellow shows up here. That idea that shows up here is that everything above the minimum of average variable cost for the firm on that marginal cost curve is the supply curve for the firm in pure competition. So the marginal cost curve above marginal cost above AVC minimum is the supply curve for the firm. To repeat, the marginal cost curve above the average variable cost curve minimum is the supply curve for the firm. Now, I said that this is 4 price levels for the firm in pure competition. And we could basically take a look at and say, okay, what's the short run and long run situation for other than pure competition? And we could say that for monopolistic competition, we could identify what's going to happen as well on these price levels as well, because we know that in monopolistic competition, in the long run, price is going to be greater than marginal cost. Price is going to be greater than the minimum of average total cost. Also, that would be true for monopoly as well. For monopoly as well, we could say that marginal cost is going to be below the price level, and margin and average total cost is going to be below the price level as well. So in those particular situations, the price levels are not going to reflect a long run situation like we're able to show here in terms of pure competition.